Hello, my name's Alice Uribe and I'm the editor of IFA. Welcome to today's MLC Roundtable on investment strategies during volatile times. I'd like to direct the first question to you, Lisa. How would you describe the current state of markets, both here and globally, and what impact this is having on retirement?
I would describe the current market environment as extremely uncertain for clients. I think it's a very challenging market environment. I think the potential for compressed returns is certainly heightened, and I think risk is also elevated. We're also seeing the ultra low cash rates at the moment distorting asset prices, which again is reducing that prospective risk-return trade-off for investors. So challenging times. From a retirement perspective, Alice, I think for the majority of clients, rather than short-term volatility, I think that the bigger risk for most clients is actually the prospect of lower than what might be regarded as normal investment returns over an extended period of time. Clearly for those clients who are in that pre-retirement phase and about to go into the retirement phase, clearly short-term volatility is absolutely an issue for them. But I think for most clients, the bigger risk is actually the prospect of low returns for an extended period of time.
And I guess that notion of volatility can be quite scary for some pre-retirees or just anyone when they hear the word volatility. So I guess maybe direct this towards you, Sean. Does it always have to be negative? Can you find ways for your clients to sort of speak to them positively and tell them how this might be beneficial?
You can't. I think it's just a directness that's needed at the moment to say we don't have all the answers. No one does. However, our primary focus is on not losing capital, because we've had a good run. This is part of the cycle, and it's about setting an expectation, however, that we are positioned, particularly with the inflation plus portfolios, which we'll touch on, where those types of portfolios where an advisor actively manages or outsources it to invest into. You can move to the lower risk areas once the storm has passed, if that makes sense. So opportunity would really only be for people who are in an accumulation phase, who are building wealth and are buying on a dollar cost averaging manner into this market.
And so Kathy, how can platforms or technologies help with having this conversation but also creating some good out of it?
The first piece is to be really close to the advisors and really working to understand what they need in terms of what we're providing on our platforms, in terms of the menu choice. And we've recently added a further 20 funds onto our menu just to make sure that we can actually provide best coverage for the model portfolios that advisors want to use to actually manage the different client needs and have the right conversations with their clients, and we enable the delivery of that.
And what sort of investment strategies would you be looking at?
I'll be very interested in Sean and Jeff's views as well, Alice, but I think what's really important at times like this, and Sean touched on it a little earlier, is for clients to have access to professional funds management, and in particular funds that actually have more latitude or flexibility to change their asset allocation than what I might call traditional funds, but with the objective of focusing far more strongly on the downside. In the MLC Inflation Plus portfolios, we're seeing a very strong take-up, particularly in that pre-retiree and retiree segment, Alice, where people are focusing a lot more on that downside risk. And to be frank, in times like these, clients need access to experienced fund managers who have done this for decades through the vagaries of many market cycles and many volatile market conditions.
So what do you think about that, Jeff, with your client base?
Now's a really tricky time, and I find myself thinking about it in a way that it breaks many of the golden rules that I've applied through not just my financial planning career but my finance career over more than 30 years. So my normal golden rules say time in the market, not market timing. My normal rules say set your risk profile, and then because you're pretty much not going to be able to pick the falls and the peaks, stay in that through thick and thin, and importantly, after markets fall, stay in there. And therefore, before you go into that risk profile, think long and hard about how much that is, and talk long and hard to the client about what falls are possible, and then make sure that they're going to be able to stay in that risk profile as you go through. But as I look at, and I'm also, one of my other rules is be very careful of somebody saying, this time it's different, and kind of, it's never before been like this. But then I look at the sheer reality of the fact that since human beings began lending money to each other in about 5000 BC, they have never loaned money at rates this low. And that, when you have, it's just astonishing that kind of 30% of all government debt in the world has got a negative interest rate on it. It's just that these things are not normal. The world is pricing into markets that the inflation dragon will never return. And my economics tells me one day it will, and I think it's a very dangerous game. But then the flip side of that is nobody can survive for long lengths of time earning cash rates of interest, and therefore there's this kind of dilemma now between, and I guess I'd call it slow ahead, where you simply can't afford to be to be too defensively positioned, because if returns are on offer, you need to get a piece of that. But I'm very, very concerned about protecting capital and trying to do whatever I can in this market, and being much more cautious than I normally am to sort of try and protect that capital as I can.
Yeah. I think that brings up a really good point. I was looking through the MLC Ipsos white paper, Australia's Today, and what really struck me was the importance of advisors. So I think what you said just really speaks to that. Those that use advisors are more likely to not think they're going to use government assistance, and they also feel more prepared for retirement. So I guess Sean, thinking about your different segments of your client base, how do you speak to a millennial client versus a retiree or pre-retiree in these volatile times?
The pre-retirees and retirees, the conversation is more expectations management. So for the clients that have been with you on a journey of at least 6 or 7 years, they're a bit more pragmatic about, well, we've had a 7-year run, typically bull runs are 6 years. If we look at some rough averages, we're into the 7th year. So they had to come, and if they're still all of those people in that framework or in that demographic are sitting on 7, 8, 9% returns post fees generally. So they're fine with it. As if they're new, that's a different story, and they're looking at the current volatility, returns below cash. They're concerned about loss of capital. So that's a important discussion. But if you've got a good manager, the better managers today are positioned conservatively but ready to move aggressively when the time's right. And that's not generally the advisor's role. The advisor's role is to manage the client more, as opposed to the money. That's my view anyway. And whereas for millennials, it's an opportunity. The sales are on, so buy it, back the truck up.
The advisor really is there to speak to the client, and I know that. So for MLC, what sort of tools do you provide advisors to speak to their clients?
It's really important that we have at the advisor's fingertips the fund profile tools, the ability to actually access information around the funds that are on the MasterKey platform, like Inflation Plus, that enable advisors to have proactive conversations around how the funds are performing and are performing against their objectives.
Speaking of different types of clients, and now looking at technology, which is again another top of mind piece. If advisors want to offer specific advice for different types of clients, how can the platform help them with that?
Ensuring that on the MasterKey platform we've got sufficient breadth of choices that an advisor can select to actually lean into those that actually want a greater growth exposure, or those that want a more conservative exposure. So it's very important that we are consistently assessing that menu and making sure it's well aligned to the conversations and the time.
And what other sort of efficiencies can the platform provide?
The elements of the communication around the performance reporting, all of the tools that advisors might use to actually enable dollar cost averaging, which Sean referenced before, and certainly permit that the advisor can actually manage their clients as a portfolio as well, rather than undertaking individual transactions. And platforms are very powerful in enabling that through technology to create efficiency so that advisors can actually be having the conversations that are required.
So client management obviously is a huge part of volatilities.
Yeah, it is. It's managing those emotions, trying to get them to ignore what I call the investment pornography that's out there. For $5 you can be told the next best stocks or which sector to be in next year. So it's just providing good counsel without imparting that you have the answers, but we're highly diversified in the way we're invested here. It's part of investing, and just explaining to them how wealth can be destroyed.
I guess we're talking about advisors having a time to spend with their clients to talk them through these sorts of episodes. What other business efficiencies, Kathy, maybe I'll direct this towards you, can free up advisor time? What sort of efficiencies can, whether it be through technology or other ways?
It's important to be mindful of what other tools advisors are using. So whether they're using desktop software to actually manage the client's total wealth picture, their superannuation, their investments. I think we need to be quite mindful that advisors for different clients' risk appetite might be using a combination of superannuation and investment strategies as well, and enabling the platforms to efficiently provide information to their desktop software like Xplan or other softwares, so that the advisor has at their fingertips what they need to be able to actually have the right conversations to their client.
Is there anything that you use day to day to increase efficiency in your business?
Yeah, absolutely. The platforms we're talking about, the ability to be a client to call and to be able to log on to the platform and immediately bring up someone's account, its 12-month performance, 5-year, very quickly. Be able to then PDF that to the client in real time. It's efficient, and it's the way we should be in 2016. So they're really important, and they're very, very helpful.
And you've obviously been an advisor for a long time. How has it changed? How have you gained efficiency over the years?
It's changed a lot. The reports used to be, I'm actually struggling to remember how it all worked, but it was pretty much you would have a statement prepared for when the review was on, and it was, the numbers were still the same. It was just, I suppose, the speed at which we can produce and the ability to show a client the performance of their investment over a longer period of time, so they can actually keep things in perspective. That can be generated in less than a minute and be sent to a client, and it helps. And then obviously the more efficiently you can do that, the more client relationships you can handle.
You have more clients, but you can actually have deeper relationships with the clients that you do have.
That's right. So we have the conversations. The platforms allow us to access that information quickly, and product is managing the risk side of things. Good managers. And you asked earlier, is there any opportunity here? There might be opportunity, but we've certainly, I think the funds management industry has evolved a lot in terms of using other asset classes to generate returns. It doesn't have to be all reliant on bonds and shares. That was one terrific development post GFC, was where the funds management industries said, well, look, we used to rely on diversifying risk by having less in shares and more in bonds, and we had a credit crunch, as you know, and now we talk about commodities and currencies and alternatives and hedge funds and infrastructure and properties in different ways. So insurance-related investments, these asset classes that don't have to be correlated with equity markets, that can generate other sorts of returns for clients. So that's something a client can't access off the street. And so again, through the combination of platform, funds management and advisor, it's a good outcome.
Lisa, can you speak to that, perhaps?
Sean's entirely right. People used to have the mindset of, what's the correlation between equities and bonds, or equities and other asset classes? But as Sean said, the GFC really showed the real risk that actually is inherent in these asset classes. Many of those, what I'd call building blocks or asset classes that Sean outlined, MLC has been using. We've been using those in our diversified portfolios for many, many years. Private equity is an asset class we've had for around 20 years. And these are very specialised investments that a typical investor, as Sean said, can't access. But a lot of those asset classes add a lot of value to clients, and also, again, can protect on that downside. So when things do go wrong, clients have a diversified portfolio. And that's the other point I'd make, Alice. Everybody might be at a different time of their life. Volatility comes, volatility goes, but the fundamentals of investing are pretty constant. Be sensible, have diversification of asset classes, understand there is always a risk-return trade-off, and markets are volatile. It's an inherent part of what we do.